Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. We're coming to you live from the MarketSite with Chris Dearborn. He's the managing director on Nasdaq's Markets Intelligence Desk. We have live reaction from the Fed interest rate hike. Chris, clearly the market's not really taking it in stride. All three of the major averages in the red. The Dow and the S&P looked as if they were going to come back. Down about 1.25% right now. The comp down just about 1%, so taking it the hardest. Are you surprised by the reaction? This was kind of telegraphed.
You know, the reaction is exactly what we were thinking. You had a well-telegraphed quarter of a point raise. It was unanimous across the board. The question was, how dovish was the statement going to be? And yes, it was absolutely a dovish statement, but it wasn't dovish enough. Maybe it was a New York pigeon. I don't know. But what you had there really was what the Fed was saying using terms, judges instead of C's. And then some of the other terminology was very, very, very hawkish, to point, more hawkish than we thought. Not really hawkish, but not as dovish, right? So the comment that really got everybody's goat was the committee judges that the risks to the economic outlook are roughly balanced, but will continue to monitor the global economic and financial developments and assesses their implications for the economic outlook. Almost all that is new. And what that means is, no, we're not going to have 3 rate hikes next year. Will we have 2? Potentially, yeah, the dot plot's looking at that right now. But what was more interesting is that for 2020, 9 of the governors are looking at a tick above the neutral rate, which is, at the end of the day, hawkish. And so you're looking at future guidance is going to happen here. And with it, the market is reacting. We got red across the board. We're up over 1% across all 3 of the major indexes, and now we're down close to a quarter to even almost a full point. Across here right now, and what you're looking at really is a knee-jerk reaction. You knew it was coming. Everyone knew it was a quarter point. That's already baked into the markets. And the markets have been extremely volatile for the last 8 weeks coming into year end. And what we're looking for is a nice dovish statement to give Santa Claus some legs for a rally, which we had this morning, and that just got pulled out from underneath us. So the question here is, the Fed's always been data dependent. Now is the Fed market dependent, and it does state that they will continue to monitor global economic and financial developments. Global economic, prices of oil, housing starts. The other day we got some housing start data that it's down 13% year over year. Any sector that is interest rate sensitive will have a negative impact moving forward if they keep a hawkish view here. And even though it's a dovish statement, the future for 2020, it's not as dovish as a lot of traders want.
Right. Well, I mean, the market also has a short-term memory at times as well. You know, my question to you is, I feel like there's a big disconnect right now with what the economy is doing and what the market is doing. And the Fed's mandate should be around global economics and, of course, domestic economics, not necessarily what the market is doing day to day and week to week. Those are 2 very exclusive things.
If you ask the president, he's got a different point.
Well, I understand. Okay, well, let's look at the level of
And the Fed
understanding.
should not be, and the Fed is a completely separate and isolated group away from the federal government. Remember, the Fed does not receive any taxpayer money. They make their money off of their balance sheet on the interest that they make off of their assets from QE and other items, and also they do not have to take any tax money. So therefore, they report to the Senate, but they're not beholden to the federal government. So the president can tweet whatever he wants. Chairman Powell will do the right thing, and right now the right thing for him is telling me that the economic data is still excellent. You have low unemployment. You have inflation's in check. You're close to 2% there. Oil could be a little bit better, more stable, but that's okay. We're watching it. As we're looking, the market's starting to go green a little bit here. You know, what the economic data is good. Wages are rising. Consumer confidence is strong. The markets have come from a very long bull run, even though right now they're looking like it might end the year flat year over year. You're still at all-time highs in the markets. And the data on the economy is good. You know, how much more do you want the Fed to do? They have 2 mandates, right? And they're doing it. And I think that right now, what you have to look at is, where do we stand as a country? Where does the macro economy stand? And what's the Fed going to do about it with the bag of tricks that they have left? Remember, a decade plus ago, they pulled out every trick they had to stabilize the global economy, and they did that.
Right. Well, we're still historically low interest rates at the end of the day. I mean, look, 10 years is a long time. It's kind of that morphine drip theory behind it. But what you're really going to be looking for, and this is in the next 10, 12 minutes or so, the presser at 2:30.
Right.
That's when I really think you're going to get some significant reaction.
Right. That's going to be the clarity off of the statement. And that's what we're looking for here. Expect some pointed questions right in there coming off of that statement. Imagine you're going to have plenty of people talking and trying to backfit what it means. only Chairman Powell will be able to tell you what that is. And
Right.
hopefully we're going to get some soothing remarks to follow up with the statement. Again, I think it's a decently dovish statement, but it has hawkish implications going forward for the next couple of years, and the economic data will tell the truth.
Right, and then we're going to get some big data in the beginning of January as well, once we start to get the retail sales numbers trickling in. And again, that's where there's a separation of how well the consumer and the economy is doing versus what the stocks are doing.
Right.
Big difference. I mean, every stock's getting beat up in the market at this point, but that doesn't necessarily mean the consumer or the economy is suffering. That's the difference.
You haven't seen a holiday ride like this with these Christmas lights in a while.
Oh, is that
right?
why you're wearing that tie? We're
It is
trying
very
to
nice.
rally for a Santa Claus rally here?
We definitely need it. There's a little bit of red in here, but we need a little bit more green. As you can see, the S&P is coming back here. The Nasdaq's coming back. The 100's come back a little bit. You know, it's going to be led by large cap companies, the markets here. And what we're looking for is how that reaction is going to take place. If large caps continue to rally into year end, that'll bolster the markets up well. And again, the rate sensitive stocks are going to be the ones that are going to be the key indicators here. They've been beaten up, and you know, sectors like housing, sectors, oil, it's all getting beaten up right now. And if that continues to rally a little bit, you're going to see a nice move. And then retail sales on top of it could have a nice start to next year.
All right, and that's our last hit of the year, my friend.
All right.
All right, have a great holiday. Happy 2018. Looking forward to the new year with you.
Excellent.
And thank you for joining Chris and I. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.